Imagine trying to move millions of tons of goods across this huge network. You're facing everything, right? Wild weather, shifting global markets. It's intense.
It really is a massive logistical dance.
Exactly. And when a giant like CSX drops their quarterly report, it's like getting a backstage pass, A chance to see how they're managing it all.
Yeah, a peek behind the curtain.
So today, that's what we're doing. A deep dive into CSX Corporation's second quarter 2025 performance.
We've got the earnings call, the press release, the 10Q filing.
Right, we've combed through it all for you. Our mission, figure out what really drove their results, how they handled, well, a pretty challenging time, and what their big moves mean for freight transport going forward.
There are definitely some interesting nuggets in there, maybe a few surprises too.
Okay, so let's set the scene. Back in Q1 2025, CSX admitted they had some, let's say, significant network challenges, pretty openly.
They did. But they also made it very clear they were committed to turning it around, fast, talking about that one CSX culture, helping them pull together.
Is it?
And based on Q2, it looks like they delivered.
Oh, absolutely.
Right.
It was, frankly, an impressive bounce back. When you look at the key metrics, things like network velocity, how fast the trains are moving, and dwell time, how long cars sit around in yards.
Right, the waiting game.
Exactly.
Yeah.
And trip plan compliance, basically, hitting their schedules. All those numbers steadily climbed all through Q2.
It's a real improvement.
Yeah, and in some cases, they were getting close to or even beating some of their best historical levels. It really shows, the operational strength there, the team's ability to overcome those Q1 hurdles.
So how did they do it? What were the actual steps?
Well, a few key strategic things. One big focus was cutting down cars online, just the sheer number of freight cars out on the network.
Okay.
But crucially, they tried to do that without messing up customer supply chains too much, so avoiding things like disruptive embargoes.
Got it. Less disruption.
Right. They also brought in some extra locomotives where needed and shifted their engineering work crews around pretty strategically, all about creating capacity, both on the main lines and, on the tracks themselves.
Makes sense. What about safety? Always a big factor.
It's a bit of a mixed bag, but definitely improving. Personal injuries were down significantly, like 26% year over year, which is great. And derailments caused by human factors also continuing to decrease.
Okay, good trends there.
But the overall FRA train accident rate did go up by 29%. Now, it's important context that most of these were low-speed incidents in yards.
So more disruption than major damage.
Generally, yes.
Yeah.
But still something they're tackling head-on. They're rolling out drones for yard inspections, improving their trackside monitoring systems to catch potential equipment problems earlier.
That's quite the operational turnaround. It sounds like a massive real-time chess game, moving all those pieces. What really enabled that pivot after Q1? Was it just better planning or something more fundamental changing day to day?
It was definitely a combination.
Yeah.
And, their COO pointed out, the weather got better, but these actions started way before that. They were really systematic about it. Looking at every single angle of cars online, working super closely with customers to trim down the pipeline, keep things flowing, basically just making sure stuff didn't sit still.
Right.
They had senior managers basically on call 24/7 in the yards. And in their main control center, their war room, actively jumping on misconnections or potential delays. It says a lot about their internal coordination, how they really adapted their operating model on the fly.
Wow. So they didn't just fix the immediate problem. Sounds like they're also making some really big bets on the future, investing in infrastructure to add more capacity. Now that's where it gets interesting.
Absolutely. And two projects really stand out. The Howard Street Tunnel in Baltimore.
Heard about that one?
And the Blue Ridge rebuild in Virginia.
Yeah.
Both are critical. And the good news is they're tracking right on schedule. Completion expected in Q4 this year, 2025.
And the impact.
Huge. They basically removed two major bottlenecks on the network.
Yeah.
It actually reopens two of their 4 main north-south routes.
That's significant.
It is. And Howard Street, specifically. Finishing that enables double-stack intermodal trains right down the I-95 corridor. That's 2 containers per rail car.
Wow. Massive efficiency gain.
Totally. Full clearance for that should come in Q2 2026 after some final bridge work. They're also doing an upgrade in their Indianapolis yard, extending the hump pullback.
Okay. What does that mean in simple terms?
It just makes sorting cars more efficient, lets them hunt more cars with less handlings, as they put it. It's a smaller project than Howard Street, but Indy is a really critical hub for them.
So all these projects together.
They unlock serious capacity across the whole network. It gives them room to grow,
Yeah.
but also, crucially, ensures customers actually feel the benefit of better service.
Okay, let's switch gears a bit. Talk about the commercial side. Sounds like CSX is dealing with, well, mixed signals in the market. Some areas strong, others slowing down.
That's a good way to put it. Mixed markets. But what's interesting is how proactive they seem to be about finding growth anyway.
How's that showing up?
Well, look at their merchandise business. Minerals revenue, up 5%, mostly driven by infrastructure stuff down in the Southeast, plus new cement production.
Okay.
Ag and food volumes up 2%. Strong grain demand, again to the Southeast. Metals and equipment up 3%, catching some good trends in steel.
So some bright spots, but there must be weaker areas too.
Oh, definitely. Chemicals volume took a hit. Partly an unplanned outage at a big customer, partly a drop in certain types of chemical shipments. Automotive volumes were down 2%. Lower industry demand overall, some production issues hitting them. Forest products felt the housing market slow down and some plant consolidation. And fertilizer shipments dropped 6%, mostly due to customer production problems.
What about coal? That's always a big piece for CSX.
Yeah, coal revenue was down 15%, even though volume was actually up slightly, by 1%.
How's that work? Volume up, revenue down?
Pricing. Global benchmark prices were way lower than last year. Think $184 a ton versus $242 for the key Australian benchmark.
Okay. Big difference.
Huge. Plus, their export business faced some production constraints. A couple of temporary mine outages didn't help either.
And domestic coal?
That held up better, supported by high burn rates at utilities, natural gas prices being higher, and faster train cycle times getting coal delivered quicker. And looking ahead, they see support from growing power demand and delays in coal plant closures.
Interesting. And intermodal, the containers on trains.
Revenue there dipped 3%, even with a 2% volume increase. Again, a mix. International did well, kind of a rush ahead of potential tariffs.
Right.
But a domestic was basically flat. The trucking market is still pretty soft, which impacts rail, and they saw less business coming off ships on the West Coast.
So tough competition from trucks.
Very much so. But they are seeing some wins converting truck freight over to rail, especially through that new Myrtlewood Interchange partnership.
Amidst all this market choppiness, how are things with their actual customers?
You know, this is really striking. Their Net Promoter Score, that metric for customer satisfaction and loyalty, it was the highest it's ever been this past quarter.
Really? Even with the Q1 issues?
Seems so.
Yeah.
It suggests customers really noticed and appreciated the service recovery in Q2. They feel CSX is getting back to being a top service provider.
That's a huge positive signal.
It is. And another one is their industrial development pipeline. They helped 25 new customer facilities open up right on their rail lines in Q2 alone. That's 49 for the year so far.
Wow, building their own demand.
Exactly. And another 30 projects are close to finishing in the second half. These serve all sorts of markets, and apparently some recent tax changes are helping spur this along too.
It really sounds like CSX is focused on creating its own growth, from the inside out, instead of just riding economic waves. How much are these internal things, the industrial development, the service focus, actually helping them compete and grab market share when the overall economy is, well, uncertain?
I think that's the absolute core of their strategy right now. By nailing operational efficiency and providing that better service, the kind customers notice, like that record NPS score, shows they make rail a much more attractive option.
More attractive than trucking, even when trucking rates are low.
Potentially, yes. Especially for shippers who value reliability and consistency. And those industrial development projects. That's guaranteed freight right on their doorstep, completely separate from wider economic trends.
So it's organic growth.
Exactly. They're actively going after what they call wallet share, trying to win business that might otherwise move on a truck. It's proactive, not reactive.
Okay, let's get into the numbers. The financials for Q2 2025. What do they look like, and what do they really tell us about their strategy, where they're putting their money?
Well, the really critical thing to see here, I think, isn't just the year-over-year comparison, but the sequential story, the bounce back from Q1.
Oh.
So total volume, right?
Yeah.
Flat compared to last year, 1.58 million units.
Yeah.
But up a healthy 4% from Q1.
Got it. And revenue?
$3.57 billion. Now, that was down 3% year over year, mostly because coal and fuel prices were lower. But again, up 4% sequentially from Q1.
Okay, so progress from the prior quarter. Where does it get really interesting?
Operating margin. This is key. It landed at 35.9%. Now, that's down 3.2 percentage points from last year.
Right.
But it jumped a massive 5.5 percentage points from Q1. That's a huge sequential improvement.
Wow. And earnings per share?
$0.44.
Okay.
Down 10% from last year. But again, look sequentially, up an impressive 29% quarter-over-quarter.
So those numbers really show that quick pivot, that ability to control costs and drive efficiency as things recovered.
Absolutely. It demonstrates real agility. This wasn't just getting back on track. It was about tightening the belt effectively at the same time. Operating income ended up at $1.28 billion, which was down 11% year over year.
What about the cost side specifically? How'd they manage that?
Well, overall expenses actually fell 4% from Q1, even though they moved 6% more freight, measured by gross ton miles. That really highlights the efficiency gains.
Impressive. Were there specific cost pressures?
Oh, sure. Inflation hit labor costs, and they had higher headcount from converting some affiliates. Purchase services costs were up too. Inflation again, plus some volume-related costs, and maybe $10 million a month in lingering costs from the Q1 network issues.
But fuel helped.
Big time. Locomotive fuel prices dropped 12% year over year. That offset a lot, even with some extra fuel used for reroutes. Equipment costs also rose a bit due to inflation and reroutes. It's really a story of managing controllable costs extremely well.
I saw something about a management restructuring, too.
Yeah, they described it as a pretty standard business review, basically reorganizing some management layers to speed up decision-making and get better alignment.
Any financial impact?
There'll be a charge in Q3, maybe $15 to $20 million. But the payoff is expected to be around $30 million in savings every year starting in 2026. So a strategic move for long-term efficiency.
Okay, cash flow. How's that looking?
Pretty solid. They generated $1.89 billion from operations in the first half of the year.
And where did that cash go?
Investments. A good chunk, yes. $1.45 billion used for investing activities in those 6 months. The big driver there was property additions, especially about $295 million just for that Blue Ridge rebuild after Hurricane Helene damage. Total spend on Blue Ridge alone is expected to top $400 million.
Wow. But overall capital spending is staying level.
Roughly, yeah. Excluding that big Blue Ridge spend, they're still targeting about $2.5 billion for the year, similar to last year.
Any other cash movements? Debt? Buybacks?
On the financing side, they used about $982 million. That includes issuing $600 million in long-term debt back in March, plus some commercial paper, but that was offset by more share repurchases.
Share buybacks.
And speaking of cash, there's this one big, beautiful bill act that passed on July 4th. Sounds impressive, right?
Yeah. What's the impact?
It's expected to give them a nice cash flow bump of about $250 million in the second half this year, thanks to bonus depreciation rules. Quite the Independence Day present for CSX.
A $250 million boost, not bad. And shareholder returns overall.
Clearly still a priority. They've returned close to $1.7 billion just this year through dividends and buybacks. They bumped up the dividend 8% back in February to $0 to 13 cents a share. And they've bought back over $1.1 billion in stock so far. There's another $1.4 billion authorized.
So pulling it all together,
yeah.
What does this mean for us watching the company? It seems like they're investing heavily for the future while also being really disciplined on costs right now. But given those economic headwinds, how much of this efficiency is just internal belt tightening versus needing the market to really pick up for serious growth?
That's the million-dollar question, isn't it? Or maybe the billion-dollar one for CSX.
Right.
I think the answer is it's both. Look at the sequential jumps in margin and earnings per share. That shows they can manage costs tightly and squeeze out efficiency as the network recovers, regardless of the broader economy. Things like the management savings, that's sustainable internal discipline. But the huge capital investments, Howard Street, Blue Ridge, those are absolutely crucial. They're building the capacity now so that when the market does eventually rebound more strongly, they're ready to capture that growth.
So building the runway while managing the current flight conditions.
Exactly. It's a balancing act. Immediate efficiency gains coupled with strategic long-term investments and solid financial management. They're showing they can deliver value now and position themselves for bigger things later.
Okay, let's look ahead then. Their guidance for the full year is basically unchanged, right? Still expecting overall volume growth.
That's the message, yeah. Effectively unchanged guidance. They're still seeing paths to volume growth for the full year 2025.
What else should listeners keep an eye on for the rest of the year?
Well, one technical point is that the negative impact from lower coal and fuel prices compared to last year should lessen in the second half. The comparisons just get easier, especially in Q4. That could help the year-over-year revenue numbers look a bit better.
Makes sense. What about bigger picture industry stuff? There's always talk about railroad consolidation.
Always rumors and speculation, yep. CSX's official line is pretty standard. You know, they're absolutely focused on delivering shareholder value, and they're always open to anything that helps achieve that. Very pragmatic.
Keep options open.
Right. But their CEO, Joseph Henrichs, offered a really interesting perspective, coming from the shipper side, having spent 30 years in the auto industry buying transportation.
Oh, yeah. What did he say?
He basically said, look, what customers really want from railroads is just better service, more reliable, dependable, repeatable, and frankly, just being easier to do business with.
Sounds simple, but maybe not always easy to deliver.
Exactly. He feels the industry historically made it too complex. So CSX is focused on that better service, easier interactions, and actively looking for ways to compete better against trucks, win more of that freight off the highways.
Speaking of competing with trucks, you mentioned that CPKC Myrtlewood interchange earlier. Is that actually bearing fruit? Are they converting truckloads?
They specifically said yes. They are seeing truck conversions happening through that interchange and sounded genuinely excited about the progress. It's a concrete example of them developing new solutions to directly challenge the trucking industry for business.
So that's a tangible win.
Seems like it.
Yeah.
And overall, the message from CSX is one of confidence. They believe they have the best franchise in the East, and they're working every day to make it stronger through service, through that industrial development pipeline, through finishing these big network projects.
And looking further out
Yeah.
into 2026.
They're projecting strong earnings growth, potentially even double digits, driven by getting those big projects like Howard Street finished, the industrial development pipeline continuing to add new business, and just ongoing cost discipline.
So we've really dug into CSX's latest results. We've seen how that intense focus on operations, big strategic bets on infrastructure like Howard Street, and really engaging proactively with the market let them stage a strong Q2 comeback, even with those mixed economic signals out there.
Yeah, that commitment to efficiency, to customer value, it really shines through. Even with all the background noise about potential industry changes, it gives a pretty clear view of their strategy moving forward.
Definitely. So here's a final thought to leave you with. As technology keeps advancing, as supply chains get even more complex and interconnected globally, think about this. How will that relentless drive to be easier to do business with, to provide industry-leading service, actually reshape the core business models of giants like CSX? Will they be forced to innovate far beyond just running trains to meet the future demands of this hyper-connected world?